Today I'm going to provide a quick market update, talk about interest rates, and talk about implications of these to our portfolios. Initially, markets reacted with a little bit of volatility when it became clear that Trump was going to follow through with his protectionist agenda and the potential impact that this could have on international trade. However, markets have since rallied. The S&P 500 has hit record highs, the Dow has hit record highs, the FTSE 100 is near record highs, and this has largely been because of the indication from Trump that he's going to be strong on growth and strong on jobs. And what tends to be good for the US economy and good for growth in the US and good for jobs in the US also translates into good news for markets elsewhere in the world. Looking at interest rates, markets are pricing in 2 interest rate rises in 2017 in the US. What sort of impact is this going to have? So we're likely to see an environment of lower income taxes, lower corporate taxes, less regulation, rising rates, more public spending, and therefore also rising inflation. The type of assets that would underperform are safe haven, treasuries, and gilts in that sort of environment. Therefore, we prefer equities because equities can pass that cost of rising inflation onto the consumer and therefore protect the shareholder. The 2 sectors that we prefer are energy stocks and financial stocks, both of which are likely to benefit from less regulation and lower taxes. But financial stocks in particular are also likely to benefit from rising rates, because this would have a positive impact on their margins, on their net interest income. Exposure to financial stocks and also financial bonds in a Coutts multi-asset fund balanced mandate, for example, is roughly 12%. So what does this mean for portfolios? We are overweight risk assets and in particular equities. We feel that equities provide far better value than bonds, which in the current environment of rising inflation and rising interest rates provide very little protection. And as such, equities are a preferred asset class. However, we are mindful of the risks ahead with regards to trade and geopolitical factors. Therefore, our overweight positions are modest. But if we do experience any volatility, and given that the underlying story is still one of positive growth, we would potentially use that volatility to add to our equity positions.